Next topic is the fixed capital and the working capital. Now, what is fixed capital and what is working capital? Every company has to invest, its capital, its funds in fixed capital or working capital, means in fixed assets or in current assets. The amount which is invested in fixed asset is called fixed capital, and the amount which is invested in the working capital, that is called current assets, right? What fixed assets are? Fixed assets are the assets which are purchased by a company for the production purpose and which are not meant for sale. For example, plant, machinery, building, right? They all are fixed assets. Whereas the working capital indicates or implies the current assets. Current assets mean the assets which can be easily convertible into cash in a shorter period of time, right? For example, bills receivable, your debtors, fine, and your stock or inventories, they are called working capital, fine. Now comes the topic, that is factors affecting fixed capital. Now, what are the factors in a company which are going to affect or which affect the amount of fixed capital, right, in a company? The first one is the nature of business. Every company has a different nature of business. Some companies, they are trading firms, you can say some are manufacturing firms, some are trading firms, there are certain companies which are sole proprietorship, some are joint ventures, right? So there are different nature of business or different nature of firms, fine. So in a trading firm, there would be less or a low fixed capital required, fine, because it's a small firm and there is a less fixed capital involved, or you can say that particular firm is into the business of that is into the business, means they are purchasing goods and they are selling goods, whereas in manufacturing firm they are producing goods, right? They are not into the buying and selling of goods, whereas they are into manufacturing of goods, they are producing goods. So where production takes place, such companies or such firms, they require huge investment in fixed capital, means they have to invest in buying building, they have to invest in buying machineries, fine, or they have to invest so much into rent and all. So they have high operating cost as well. So such companies, such firms, they required high fixed capital investment. Second point is the scale of operations. Now we'll see, the company will look at the scale at which the firm is operating, or the company is operating, or the business is operating. If a company or if a business is operating at a large scale, so obviously that requires high investment in fixed capital, whereas a company which is small in nature or which is running at a small scale, such company, such business requires low investment in fixed capital, right? Third one is choice of technique. Business has two major types of business techniques, that is capital intensive or labor intensive. Some business they are capital intensive, some business they are labor intensive. Means labor intensive company or a company in which more laborers they are employed, whereas capital intensive a company which is using more machineries, right? So if a company which is capital intensive or which is having more number of machineries, such companies they will require more investment in fixed capital. Again, they'll have to invest in buying more buildings, more machineries, they'll have to invest heavily in technology, fine, whereas a labor intensive company or a business will require less investment in fixed assets, fine, they'll have to invest more in labor, so they'll have to invest more in giving wages, fine, or the salaries, fine. Fourth point is technology upgradation. Technology upgradation, if in any company fixed assets they have become obsolete, Fine, they have become outdated. So now there is a requirement of replacing the assets with the new or the upgraded technology. So if a company is going to invest in the upgradation of technology, then obviously they require higher amount to be invested in fixed capital. Fine. Next point is financing alternatives. Financing alternatives. Now what options or what alternatives are available for the financing purpose, when financing for the fixed assets, right? Fixed assets are sometimes some companies they go for using or taking the fixed assets on lease, right, and they pay lease rent on that. Fine. So if a company is going for such option, then obviously that particular company require lesser amount to be invested in fixed assets. Fine. Next is diversification. Diversification, if a company is going for the diversification, means they are changing their nature of business or they are changing the manufacturing of the product, right? So if they are changing their business, they require more capital investment because they have to come up with a new setup of business. So a new setup of business obviously requires a huge amount to be invested in capital, in fixed assets. Next is growth prospects. If a company is having an anticipation of growth, means a company is anticipating for higher demand for any product, then obviously they have to have stock of the products, and eventually they'll go for higher production. Fine, because they have an anticipation of high demand of product in the market, so they'll go for the higher production. For higher production, they'll have to invest in fixed asset, they'll have to buy more machinery, they'll have to upgrade their technology, so there will be a higher amount of capital invested, capital to be invested in fixed assets. Fine. Next is level of collaboration. Level of collaboration reduces the level of investment. If a company is collaborating for some of its operation to the other company, fine. For example, if a company has to use some parts for making cars, and some parts are being manufactured in that particular company, and some parts they are they have a collaboration with other company. The other company will produce those particular parts. Fine. So few parts are produced in this company, few parts are produced in the other company, and they have collaboration. So obviously they have to invest less in the fixed assets. Fine. Ninth is contribution for working capital. Out of total capital of the company, some part of the capital is to be invested in the current assets, means the assets which can be easily convertible into cash. As I told you, the stock, inventories, bills receivable are debtors. So a fixed amount has to be used for the current assets. Fine. So how much amount we are using for the current assets, for buying current assets, that will decide our proportion of investing in buying fixed assets. Let's start with the next topic, that is factors affecting the working capital requirements. So first we will discuss what working capital is. Working capital is the investment which we make in current assets, or the assets which can be easily convertible into cash within a short period of time, maybe of 1 year, right? Such current assets they include our stock, inventories, our bills receivable, our debtors. So they all are a part of working capital, or you can say the current assets. Fine. Current assets, they indicate or they facilitate day-to-day operations of a business, right? They facilitate day-to-day operations of any business, right? Before coming to the nature of business or the factors which affect working capital requirements, I would like to tell you that there is a word which is called operating cycle, right? Which is called operating cycle. The concept of operating cycle. What operating cycle is. Operating cycle means that the time period, it's a period between receiving the raw material and converting that raw material into a product, right, and getting cash out of the sale of that particular product, right. So converting the raw material into cash receivable, right, that is called the operating cycle, right. For any trading firm, right, a trading firm which is involved in buying the product and selling the product, right. So you will see that in a trading firm the operating cycle is very short. They have a very short operating cycle, whereas in a manufacturing firm is they are into buying the raw material, then the raw material will get through all the production process, fine, and then that particular finished product will be sold in the market, and then it will be converted into cash. So you will see that any manufacturing firm, it has a longer operating cycle, whereas a trading firm, it has a small or short operating cycle, right. So how operating cycle, that is related to the nature of business. Trading firm, in trading firm we have short operating cycle. Short operating cycle means it takes lesser time to convert the raw material into cash, right. And in manufacturing company, it takes longer period of time to convert raw material into cash or bills receivable or debtors, or collecting cash from debtors, right. So it has a longer operating cycle. Second is scale of operations. Scale of operations means the level at which a company operates. Fine. If a company is operating on a large scale business, then obviously the working capital requirement will be more. Fine, because there is production on high level, so obviously for that they require more working capital, more cash in their hand. Production is higher and demand is higher, production is higher, and a company is on a very high level, or that's why they require more working capital. Whereas a small scale business, since the business is on lower level, so they require less working capital. Fine. Third is business cycle. Every business has a cycle. Fine. You will see a business, it establishes, it grows, it reaches to the saturation point, and then it declines. So there is a business cycle of every company. Fine. You will see when a company is at the boom, or you can say it's on its peak, or it's growing. Fine. So there you will see in that company, or for that company's product, there would be high demand, right. There would be high demand, or you will see people, they are demanding more and more that particular product. So if demand is high in the market, then company is supposed to produce more. For producing more, the production has to be done on a large scale. If there is a high production, there would be high demand of raw material. Fine. If there is a high demand of raw material, then obviously high working capital is required. Fine. Whereas if a particular business is on slack, is having a slack period or a depression period or a declining period, then that particular company doesn't need high working capital. Fine. Fourth is seasonal factor. You will see that there are certain business which has a seasonal cycle. Which has a seasonal cycle means that particular business, it functions in a particular season. It has a very, very small cycle of operation or operating cycle, which is confined to or limited to a particular season. For example, you will see any company which is into the manufacturing of woolen wear. Fine. So their company will on boom, or their company will grow, or their sale or their products will be in demand in the in winters only. There is a time limited, that is winters. Fine. So they'll require more working capital in winters because demand for their product is generally high in winters, because in winters people they demand woolen clothes. So in winters, particularly in winters, they will be requiring more working capital. Fine. So in that way, how working capital requirement, it is affected by the seasonal factors. Fifth one is production cycle. Now comes the production cycle. Every product undergoes various production process, various production phases. Fine. So a production is basically what? Production is converting input into output, converting raw material into finished good or finished product. That is called production. So you will see that every product before becoming a finished product, right, there are various stages which it has to pass through, right. You will see that all products, different products, they have different production cycle. Fine. Some product they have shorter or the small, shorter production cycle, and whereas some products they have longer production cycle. For example, there is a company which is into manufacturing of cars. So obviously car will have a longer production cycle, whereas a company which is into manufacturing of cycle, they will be having less, shorter production cycle. Therefore, they will be requiring those particular companies which are into manufacturing of cycles, they will be requiring lesser working capital in comparison with a company which is into the manufacturing of a car, right. Now, sixth point, that is credit allowed. If a company sells goods on credit, fine, if a company sells goods on credit and gives long period of payment to the debtors, right, such companies, they require more working capital, because the period between providing goods to, selling goods to the debtors, and and when they'll give you the payment back, the period is really very long. Fine. Product and cash. So the period between converting the product, the finished product, into cash, right, the cash which we are going to receive from the debtors, that is long. So meanwhile we will be requiring more working capital to invest for further production, right. Whereas the companies which provide goods on credit, right, which provides good on credit and the provides a shorter period to debtors to make payment. Fine. Such companies, they require less working capital, because again the period between converting the goods into cash is very short. So that's why they require less working capital. Fine. Seventh point is credit availed. Now a company which is manufacturing product, they also take raw material on credit, right. They also get credit facility, they avail credit. Fine. So if any company which is getting raw material or goods on credit, right, for a longer period of time, fine, so such companies, they will be requiring less working capital, whereas the company which are availing credit and that credit availing period is very very short, fine, such companies, they will be requiring high working capital. Fine. Eighth is terms of purchase and sale. Sometimes there are few companies which buy product on credit. Whatever purchases they do, it's on credit. Fine. For example, they are buying raw material on credit. Fine. And that credit avail period is longer. Fine. They are availing raw material, they are purchasing raw material on credit, whereas they are selling those finished product on cash. Fine. So such companies, they are having cash inflow. right? They are having high cash inflow, so they will be requiring less working capital. Whereas the companies which are not purchasing, goods on credit, and they are not having that credit facility, or you can say the terms of purchase and sale means they are not purchasing on credit, they are purchasing on cash, and they are selling on cash, right? So they will be requiring, or they'll be requiring high working capital. Working capital will be required more, and there are certain companies which are purchasing on cash, right? Whereas they are selling on credit. Fine, they are selling on credit, so they need to get the payment from the debtors. So such companies, again, they will be requiring more working capital because their money is stuck in the market, and that period of converting the product, the finished product, into cash from the debtors, that is longer. That's why they require more working capital. Fine. The last topic is availability of raw material. If a raw material is easily available, fine, if it is easily available from the suppliers, from the sources of acquiring raw material, if it is easily available, then there is no need to maintain inventory. For example, if we require raw material for producing any product, and if that raw material is easily available, fine, then we don't need to have a stock or keep a stock or inventory for that particular raw material, for any raw material, right? So in that case, we don't have to invest or invest our money in raw material. Fine. So in that case, the less working capital is required, because you don't have to, your money will not be stuck in the that inventory thing, the stock thing. Fine. Whenever there is a need of raw material, we'll pay cash and we'll get the raw materials. Fine. So no money will be stuck for the purpose of stock or inventory. Fine.